Can you characterize everything that the Fed has done this past week as essentially flooding the system with money?
Yes, exactly.
And there's no end to your ability to do that?
There is no end to our ability to do that.
Is the Fed just going to print money?
That's literally what Congress has told us to do. That's the authority that they've given us, to print money and provide liquidity into the financial system. And that's how we do it. We create it electronically, and then we can also print it with the Treasury Department, print it so that you can get money out of your ATM. I heard from a bank in our region, a well-to-do customer came in and said, I want to withdraw $600,000 of cash. Now, we can supply all the cash that the banks need to meet their customers' concerns, but it just speaks to the fear and the uncertainty that is rippling through the economy.
To the person who is about to grab their car keys and go to the ATM and take out $3,000, you say what?
You don't need to. Your ATM is safe, your banks are safe, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
Will the Federal Reserve ensure that banks have all the cash they need to satisfy whatever withdrawals may be coming?
Yes, this is the fundamental reason the Federal Reserve exists. We call it lender of last resort. This is literally why central banks exist. If everybody gets scared at the same time and they demand their money back, that's why the Federal Reserve is here, is to make sure that there's liquidity, that there's money to meet those demands. We will absolutely meet those demands.
What did we learn from 2008 when you were in the Treasury Department, and how is that being applied today?
There are two big mistakes when I look back at 2008 that we made that I think are relevant today. Number one, we were always too slow and too timid in responding to the crisis. The reason is we didn't know how bad it was going to get, and we didn't want to overreact. And it turned out it got really, really bad, and the right answer should have been overreacting to try to avoid the devastating recession that we ended up happening. So today, whether it's healthcare policymakers, fiscal policymakers, which means Congress, or the Federal Reserve, we should all be erring on the side of overreacting to try to avoid the worst economic outcomes. We are being very aggressive, and I think our chairman, Jay Powell, has learned from the experience of 2008. We're moving much faster than we moved in 2008. We're being more aggressive. Is there more we can do? Yes. Is there more we may end up doing? Yes. But I think we're being very aggressive, and I think that's the right thing. Millions of people are going to lose their jobs, and that's what's so scary about this.
Are we in a recession?
If we're not right now, we will be soon. My base case scenario is we will at least have a mild recession like after 9/11. The worst case would be we'd have a deep recession like the 2008 financial crisis. We just don't know right now.
And what's keeping us from knowing with any certainty?
Nobody knows how the virus is going to progress. How many Americans are going to get it? How effective is social distancing going to be? How long will it take the healthcare system to catch up?
Nationwide last week, there were almost 300,000 people filing first claims for unemployment benefits.
It could be 5 times that amount next week, maybe more.
Where is the bottom?
If this is a 3-month shutdown, we'll find the bottom pretty soon. If this is a year-long shutdown, this could be very damaging to the U.S. economy and most importantly to the American people.
If the current measures are not enough, what else can the Fed do?
So there's a range of things that the Federal Reserve could do, but we're far from out of ammunition.
Far from out of ammunition. Sunday, the Federal Reserve lowered its benchmark interest rate to 0. Can you go below 0?
In theory, we could. Some countries have. I don't think any of us on the committee think that's a particularly good idea. It creates other challenges for financial markets. But in the last crisis, we used something called quantitative easing, buying long-term bonds. We've got a lot more experience on how to do that. It didn't trigger inflation. So there are other tools that we've used before that I think we could also use again and use again aggressively.
People are shunning U.S. Treasury bonds, which are always thought to be the safest possible investment.
It is. Now, keep in mind, Treasury bond prices are still very high relative to history. They're just not quite as high as they were a few weeks ago. So they still are viewed as a very safe investment, very attractive for a lot of people. But just this fear of where the virus is going to go is leading people to say, I just want cash. And if that's cash under my mattress or in my safe, I'll sleep better at night.
What's it going to take to get the bond markets working again?
I think a combination of factors. I think Congress taking bold action to say they're standing behind the U.S. economy, the $1 trillion stimulus they're talking about. I think that'll help. I think continued actions from the Federal Reserve will help. And I think more confidence that the healthcare system is catching up to the crisis. Your ATM is safe, your banks are safe, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system. There's an infinite amount of cash at the Federal Reserve. There's an infinite amount of cash at the Federal